Continue with video 3. We now look at reserves. There are a number of different types of reserves which you'll find in the financial statements. We've looked at one already, the share premium account. Which we determined in the previous question that it can be used to issue bonus issues and to increase if shares are issued at more than the nominal value. The other reserves would be the revaluation reserve. Apart from the revaluation reserve, there will also be other reserves which you meet in the next level. You don't get tested of other reserves at this stage, but in level 2 you get to meet the other type of reserves. The other reserves is the retained earnings, which again we've explained that it's a profits, cumulative profits which have not been distributed, which are coming from previous years and they're being reinvested in the business. Now, let me make a point of emphasis at this point. Do not interchange or misuse these two words, profits and retained earnings. Profits are for a period, the period in which you are operating, that year when you're operating. Those are what we call profits. Anything which is coming from previous years up to date, including, if it includes, so if this year's profits include last year's and the other year's profits, those are known as retained earnings. Students tend to interchange these words and then they keep on getting things wrong. In the layman's language, it's okay, you'll be excused. But as an accountant and for your exams, if you interchange these two words, be rest assured you get your answer wrong. So do not interchange these two words. Each one has got its own meaning. Therefore, even the way you handle them in the calculations, it will be different. When a company has been performing well, the directors may declare dividends. Dividends are paid to the shareholders of the company. And the dividends are paid based on the number of shares which each individual shareholder has. So a dividend is a distribution of profits to the shareholders, or it can come out from the retained earnings of the business. So let's look at an illustration. Suppose a company with 1,000 ordinary shares of $1, so the $1 there is the nominal value, made a profit of 500 in its first year. The company has two choices to make. It can distribute this profit, this 500, as dividends to its shareholders, or it can reinvest this 500. If it reinvests the 500 in the business, the name changes from profits to retained earnings. But if he decides to pay, say, a dividend of 10 cents per share, and then to retain the remaining profits, how much of that 500 will be paid out as dividends? So 1,000 times 10 cents will give us 100. So the 100 will be paid out as dividends. The 400 will be reinvested, and the name will change from profit to retained earnings. Dividends are paid out of retained earnings. Dividends are not a business expense, so you do not subtract the dividends from your profit in the income statement. The only dividends that you bring in the income statement is the dividends which you receive yourself if you have invested elsewhere and then you are paid dividends as a company. But when you are paying dividends yourself as a company, you do not include these dividends in the income statement as an expense. Please take note, dividends are not a business expense. Dividends are paid out of retained earnings, so they will be shown in the statement of financial position. A company may pay dividends in two stages. It may pay an interim dividend, which may be midway through the year, and the final dividend at the end of the year. So how do you treat these two types of dividends, the interim and the final? So as a company, you want to declare the dividends at the end of the year when you know how your company has performed in a particular year. If the dividends are declared in the current year, then they'll be accounted for in the current year. But if the directors wait until the financial statements have been prepared and closed, then the dividends will be disclosed in the note to the financial statements. Let's look at an example question. We've got ABC Core, which has the following capital structure. It's got 100,000 ordinary, 100,000 preference 6% $1 preference shares. It's got 200,000 50 cents ordinary shares. The retained earnings at the beginning of the year were 125. Then during the year ended December X7, it made the following profits. Profit before tax was 60,000, income tax expense 10,000. The profit for the period, or profit after tax, 50,000. Dividends paid and declared during the year were as follows. There was an interim dividend which was paid out in the course of the year of 5 cents per share. Then a final dividend was declared. Again, see the words they are using. The 5 cents was paid. The final dividend of 10 cents was declared in January of the following year. you are required to show the movement in retained earnings of ABC for the year ended 31st December X7. So our retained earnings at the beginning of the year was 125. Then in the current year we've made a profit of 50. So this profit goes and joins the retained earnings, so 125 plus 50. Then from this we take out the preference dividends. First, you will recall when we looked at the tutorial for preference dividends, we said the preference dividends receive their dividends earlier than the ordinary shares. The preference dividends are part of a finance costs. Preference dividends do not come out after tax, although they are recorded in the statements under the retained earnings. So 6% of 100,000 gives us 6,000. So that's a 6,000 there. Then the ordinary dividends paid in the year was 5 cents per share. So 5 cents times 200,000 gives us 10,000, which is at 10,000 there. Add the 2 to give us 16,000, subtract from the retained earnings. So the retained earnings at the end of the year are now 159,000. The one declared, it will only appear in the financial statements of 20x8 once it is paid in 20x8. We look at long-term borrowings. A company may choose to raise finance by issuing shares or by raising debt. Raising debt will simply mean the company goes on the financial markets and borrows either through the banks or through other providers of finance. There are various ways in which a company can raise finance: through issue of loan notes, such as loan stock or debentures. These loan notes, they usually carry a fixed rate of interest, and they will have a predetermined redemption date, meaning you know how much interest rate will be applicable on the loan, and you know the date on which the loan is going to be redeemed. Redeemed simply meaning when the loan is going to be paid off. So in this example, we've got a loan of 50,000 paying 10% interest, and it to be redeemed, this 50,000 will be redeemed in 2012, meaning the 50,000 should be paid back in 2012. We've said loans pay interest. This interest is also called a finance cost. The finance cost is an expense in the income statement. Expenses, we've already learned that they've got a debit balance. So the finance costs or the expense interest will debit finance costs in the income statement and will credit the bank in the statement of financial position. The last thing to be subtracted in the income statement is income tax. When you're a company, you must pay tax on the profits that you make. The tax is payable after the end of the financial year. So since it's payable after the end of the financial year, because you have to first close your financial year, that means that at the end of the financial year, you have to include an accrual for what the directors think is the best estimate of the tax due on the profits for that particular period. This accrual is shown as an expense in the income statement, and because you have not paid it, it will also appear as the current liability in the statement of financial position. What's the accounting treatment? The accounting treatment, because it's an expense, you'll have to debit income tax expense in the income statement and credit your current tax payable in the statement of financial position. Then when the actual tax is paid in the following year, you will have to adjust the next financial year statements for any under or over provision of income tax. Remember, you're just making a best estimate. So that best estimate may not be the actual amount of tax which is due in that particular year. So that would cause the company to have an under or over provision of tax. We continue the lecture in the fourth video.